fiscal cliff. Let's bring in Peter Schiff. He's CEO of Euro Pacific Capital. And with us is former Clinton advisor Doug Schoen. All right, so gang, Peter, first to you, we're at an impasse. We've got basically Mr. Boehner saying, look, you, Senate, you have yet to come up with any kind of a deal. The House has done its job. What do you make of the impasse right now?
Well, I think, unfortunately, we'll probably get around it. I think the U.S. economy is in big trouble either way, but I think that it's a worse outcome to avoid the cliff than to go over it. But I think we should broaden the discussion and look at what's going on around the world. You know, look at what's happening in Japan and Europe. In Japan, they just had an election, and it basically proves that Americans don't have a monopoly on stupidity. But the Japanese government is declaring war on Japanese citizens. It's going to debase the yen. It's going to create inflation. That's not going to grow the economy, but it might prick the bond bubble in Japan and JGBs. And if the Japanese citizens start to dump their bonds and the Bank of Japan has to start buying JGBs instead of treasuries, they've been a bigger buyer than Japan recently. That's a big problem for us. And in Europe, the euro has been quietly appreciating even more than the dollar. If a lot of that safe haven flows that went into treasuries goes out, that's a much bigger fiscal cliff if the big buyers of treasuries become sellers and interest rates really start to rise.
You know, there's a lot of ifs, though, Peter, in your argument. I want to turn to Doug Schoen. I hear what you're saying about the Japanification of the U.S. But, you know, Doug, the bond markets are still pretty quiescent. We haven't seen a lot of action, nothing from the bond vigilantes yet. You were a Clinton advisor. You saw, though, in the mid-'90s, bond yields really spike higher because the economy was getting healthier. And that's the issue, too, right, Doug? If we see the economy healing, bond yields could go up as investors say, wait a second, why invest in bonds? We're just going to go right for stocks. Square. Go ahead.
You see, that to me, Liz, is the key issue. We haven't seen interest rates spike for a simple reason. Nobody has confidence in the economy. Nobody believes we're going to have robust economic growth. And I think there's a substantial reason, given the confidence numbers today from the University of Michigan, to believe that we could well be heading towards a recession, especially given the disappointing Christmas sales. So I'm frankly skeptical about what's going to happen with our economy. Either way, I think we're going to go over the cliff. And with the debt ceiling limit being hit, Liz, I'm getting more and more pessimistic by the hour.
You know, here's the issue, Peter. It's more that, I hear what you're saying, it's more that we've got D.C. dysfunction in high definition. This is political theater in D.C. at its most neurotic. And I think the issue, what Doug is pointing out, it's not really a bond market issue right now. Is that right, Peter? It's more about how it hits consumer wallets. Go ahead.
Well, it's going to be a bond market issue. You know, the public is not going to gain, or investors are not going to gain confidence in our economy. They're going to lose confidence in the U.S. government's ability to pay its bills without creating massive inflation. They're going to lose confidence in treasuries. That is the big problem. That's the Achilles heel in this phony economy. Because, yes, interest rates have been artificially low. They're not going to stay artificially low. And when foreigners start selling dollars, rates are going to go up and consumer prices are going to go up. And that's really going to hit consumers hard. Take a look at what's happened in the crude oil market. That chart looks really, really strong. You can see a huge breakout in oil prices and food prices in 2013. That's going to hit the consumer right in the wallet. And Ben Bernanke has already said he doesn't care how much his inflationary monetary policies pushes up the cost of food and energy. He's going to ignore that and just going to feed the fire by printing even more money.
All right, Doug, what do you make of that?
You know, I just believe we are in a holding action till we resolve these immediate political problems. I agree with you, Liz. This is a political crisis first and foremost. It is a weak economy, getting weaker. Bond yields even today are going down. I think what Peter speaks of is certainly possible in the near future, perhaps the more distant future. But bottom line, I expect more softening and a lack of confidence in all financial markets.
It's more of a political day of reckoning than a political crisis. The fact of the matter is big government is very expensive, and we're finding that out. There's no free lunch. If we want all this government, we need much higher taxes on the middle class, not on the rich, but on the middle class. And if the middle class doesn't want to get stuck with this bill, then we better start slashing government spending fast.
Peter, if you can figure out how to sell that one, I'll be happy to put you into Washington to advise both sides.
All right, we got to leave it there. Thank you, Peter Schiff and Doug Schoen.
Let me in.
Okay, really appreciate it, gang.